Welcome to The Explainer. Okay, today we are unpacking what has got to be the ultimate paradox of the 2026 global economy. Think about it. On one hand, we're facing this unprecedented global geopolitical chaos and a historic energy crisis, right? But then, on the exact same timeline, we're witnessing absolutely record-breaking stock market growth. So how is this even possible? Well, the answer really lies in understanding how AI scores predict growth, both at the massive macroeconomic level and all the way down to individual retail stock portfolios.
Okay, let's dive into this. Here is our roadmap for today. First, market chaos versus AI growth. Then, AI driving macro earnings. Next, how AI scores stocks. After that, tracking sentiment and risk. And finally, we'll wrap up with the statistical edge.
Section 1. Market chaos versus AI growth.
So to really grasp what's happening with the current financial markets, we kind of have to look objectively at our 2026 global reality. And I want to pose this paradoxical hook directly to you. How exactly is the market soaring during a global energy crisis? Because if you look at the geopolitical data, the 2026 Iran conflict has caused some severe disruptions. We're talking about the closure of the Strait of Hormuz. The International Energy Agency literally called this the greatest global energy security challenge in history. It's disrupting roughly 20% of global seaborne crude oil and liquid natural gas supplies.
On one hand, the ripple effects are absolutely massive. Global supply chains are facing historic disruptions, European gas prices have surged, and inflation forecasts were obviously raised. But get this, in stark contrast, the S&P 500 actually jumped over 17% between March and July of 2026. The International Monetary Fund even revised its world GDP growth rate upward to 3% for the year. So what on earth is keeping the global economy afloat?
Moving to Section 2, AI driving macro earnings.
And this brilliantly illustrates what's happening. The anchor holding this entire market together is the massive, unprecedented corporate investment in artificial intelligence. AI is literally offsetting the negative economic effects of a global oil supply shock. Take a look at this from Raymond James Investment Strategy. Despite the massive headwinds of the Iran conflict, they actually raised their 2026 S&P 500 earnings estimate from $300 up to $326 per share. That implies roughly 21% year-over-year growth. But here's the critical detail. 80% of this upward revision is driven solely by tech-related companies.
Which brings us to just a staggering number, $720 billion. This represents the revised 2026 hyperscaler capital expenditure. That is $720 billion pouring directly into AI infrastructure just this year. To put that into perspective, this build-out is so massive that it's driving up demand for industrial companies that supply electrical hardware to data centers. So it's expanding the economic benefit way beyond just the tech sector itself.
These mega-cap tech giants, often referred to as the Mag-Man composite, they are essentially putting the broader S&P 500 on their backs. They delivered a whopping 59% year-over-year earnings per share growth in Q1 of 2026. And the rest of the S&P 500? Just 12%. This marks the 13th straight quarter of earnings outperformance by these tech giants. They're doing all the heavy lifting, carrying the broader index right through those global oil shock fears.
All right, Section 3. How AI scores stocks.
So we see the macro picture, right? AI is the engine. But how do everyday investors actually evaluate specific stocks to navigate this crazy volatile environment? Well, to understand AI stock scoring, we first have to understand market sentiment. Simply put, it's the overall attitude of investors towards a stock, and that is what directly drives price fluctuations. Platforms like StockGeist are now using AI to analyze live social media comments and thousands of news articles in real time to quantify this exact market psychology. It's taking human emotion, the panic or the greed we all feel during breaking news, and turning it into measurable, actionable data.
Now, what's really interesting about this slide is just the sheer volume of information being processed. An AI doesn't just look at a static balance sheet. It's constantly scanning asset performance, sector movements, interest rates, macroeconomic indicators, institutional order flow, and of course, that social media sentiment we just talked about. It is taking in millions of data points simultaneously. It's like a giant puzzle, and the AI is putting it together at a speed far, far beyond human capacity. And retail investors have amazing access to this data now. This compares 3 of the top AI stock analysis tools from the 2026 rankings. Prospero distills millions of institutional data points into just 10 plain English signals. Danilfin processes over 10,000 features per stock daily to output these incredibly transparent 1 to 10 AI scores.
And Zen Ratings utilizes a neural network to condense 115 fundamental and technical factors into really simple component grades. These tools aren't just Wall Street secrets anymore. They're the great equalizers for retail investors, distilling infinite noise into highly actionable insights.
Section 4. Tracking Sentiment and Risk. Because finding a good stock to buy, that's really only half the battle. Think of your portfolio like steering a car. Even on a perfectly straight road, you need to make micro adjustments, or you're going to drift off course. AI handles this through rule-based rebalancing. Basically, the AI constantly monitors your asset mix against your personal goals. If it detects a deviation, say a massive bull run suddenly pushes your equity exposure up to 80%, it automatically triggers a rebalance. It does this without delay, and crucially, it completely removes human emotion and panic from the equation.
At the end of the day, unmanaged risk is just plain dangerous. Traditional portfolios often carry hidden risks if rebalancing is ignored. AI actively solves this by making small, smart adjustments based on real-time global economic data. So it avoids overexposure during the good times and increases safe assets when global uncertainty strikes.
And finally, Section 5, the statistical edge.
Okay, so we've talked about the logic, the models, the risk management, but let's bring this explainer home by asking the most important question. What kind of actual verifiable returns is this technology generating for investors? Well, check out the results of this 2026 Stanford study. It is truly eye-opening. When comparing AI analysts against human mutual fund managers over a 30-year window, the AI generated 6 times more alpha and outperformed 93% of the human fund managers. Safe to say, a few Wall Street veterans are probably sweating right now. Just 7% of human managers could beat the machine.
So the crucial point is this. AI isn't just some magic wand, but it is a verifiable statistical edge. Take Daniel Finn, for example. Their back-tested best stock strategy, which relies purely on their AI scoring model, returned an incredible 376% between 2017 and mid-2025. Over that exact same period, the S&P 500 returned about 166%. The data really speaks for itself here. Stocks with the highest AI scores consistently outperform the market.
I want to share this quote from the Prospero team because it hits the nail right on the head. Modern stock analysis is a data problem. No human being can synthesize earnings transcripts, SEC filings, real-time sentiment, and institutional order flow across an entire portfolio. It's impossible. AI has become the ultimate tool to solve this exact data problem, giving everyday retail investors true institutional-grade capabilities.
We've seen how AI infrastructure is literally propping up global economies during historic crises, and we've seen how AI scoring models are completely leveling the playing field for retail investors. So I'll leave you with this. Armed with these incredible AI tools, how will you navigate the markets of tomorrow? Will you rely on human intuition, or will you let the data guide your growth? Thanks so much for joining me on this explainer, and keep learning.